All right. And people are starting to file in. Everybody walk to the front, please. Take the middle seat. This isn't Southwest Airlines. And then let me make you a presenter so that we can jump back and forth. Okay. All right, I assume that everybody can hear the sound of my voice. Those of you that have been here before know what the drill is. You know, somebody raise their hand if you can hear me. If you can't hear me, raise your hand. That, of course, doesn't make any sense because they wouldn't be able to hear me. I don't see anybody's hands up yet. David, can you hear me? So let's just say my hand is up. Robert says he can hear us. David, I called him out and now he raised his hand. So people, they're just shy. I get it. I get you. All right. Mary, good to see you again, or virtually at least. All right, well, welcome everybody. Today, we're having a presentation on commercial lending. What's the difference? What do you need to know? How to get the best commercial loan, who to talk to. And I would like to introduce Ben Johnson with Gantry Mortgage in San Francisco and let him take it away.
All right, hey, thanks, Michael. I'm Ben Johnson. I work for a company called Gantry Inc, headquartered in San Francisco. The company until December of 2019 was known as Newmark Realty Capital, in case you've heard that name before. The company, I'll give you some points on the company a little bit later in the presentation, but it was founded in San Francisco in 1991 by three commercial mortgage brokers. Since that time, we've expanded into other markets, mostly on the West Coast. And I'll rattle off where we have offices later in the presentation, but we're based here in the Bay Area, but doing commercial loans all throughout the United States. We can lend on any commercial property in any state. So most of our clients, you know, are based in the Bay Area or Northern California, but the properties we lend on are everywhere. So I'm gonna show a presentation now that I put together. Can everybody see this first page? It says Bay Area Real Estate Professionals.
I can see it.
Okay.
Yeah, you're live.
All right, great. So as I mentioned, my name's Ben Johnson. I started off in the industry in 2006 working for CBRE in their Las Vegas office in an entry-level position in research, and then moved into commercial valuation and worked as an appraiser for CBRE in various offices all the way through 2016. During that time, I covered initially, you know, Nevada and Northern Arizona and Southern Utah. And then when I moved to the Bay Area, started covering Silicon Valley and the Central Coast. And when I moved to CBRE's Walnut Creek office, then my territory was the North Bay and the Central Valley. So during my time in appraisal, I covered, you know, a number of different markets and learned how to underwrite, most importantly. Moved into commercial mortgages in 2016, and I've been in that part of the industry ever since. First for a local commercial real estate mortgage brokerage, and since 2018 with Gantry in San Francisco. If you need to get a hold of me after the call, my cell number and my email address are right there. I wanted to talk a little bit about our company's production in 2020. In 2020, we originated about $3 billion in loans and closed over 400 loans during that time. And we did those 400 loans with over 100 different lenders throughout the country. So we don't, when we get a loan opportunity, we don't just take it to a go-to lender and call it a day. We tend to work with a lot of different lenders and market loans for our clients really extensively. There's a pie chart in the right part of the page. It shows the breakdown of the types of loans that our company works on. It varies by team, but we do a lot of loans with life insurance companies, where a life insurance company is the lender. We do a fair number of agency loans, apartment loans or mobile home park loans with Fannie Mae and Freddie Mac. And then we also do bank and credit union loans, bridge loans, and then some private money loans as well. Our 2020 was a little bit down in terms of our typical production. We were planning on being closer to $4 billion during the year, but some production teams had a lower number of closings because of the pandemic. Our team of 4 people had the best year that we've had, and we were able to win a lot of the business that was going directly to banks before the pandemic. This slide I'll let the participants look through on their own time. This shows some of the lenders that we work with frequently as a commercial mortgage brokerage, which is what we are. And some of those names you might recognize and some you might not, but you've basically got investment banks in there and life insurance companies, and then some of your retail banks that have good brand recognition throughout the country. There are some total production numbers for our company right there. If you want to look through those historically, we've got 61 mortgage brokers or associates, and then we've got the rest of the employees work in other capacities. Basically, our company has 2 things that we do. We originate new loans, and then we have a servicing arm, so we service loans, and currently service between $16 and $17 billion in loans that we've originated. Here are some transactions that I've worked on recently to give you an idea of the types of loans that our team of 4 works on. The top left one is just a refinance where the property owner had kind of a higher interest rate on some apartments in Los Angeles and was hoping to take advantage of the low interest rate environment we're in. That one closed last year. A Dollar General in Tennessee that was a small loan to a California-based borrower who didn't have a lending relationship in Tennessee, so he came to us and we got that one closed for him. An SBA loan on a vacant building in Oakland that was purchased by a business to expand their number of locations, and the business was a provider of early education. The bottom left is a picture of a hotel loan that we closed early in 2020 with a life insurance company, and that was the interest rate on that was one of the lowest interest rates that we've ever been able to get on a loan, but that was before the pandemic hit. A Walgreens in the Central Valley that we're doing with a credit union based in the Midwest, and then the last one is a large apartment construction loan on a property in the Central Valley where the developers plan to build a market rate apartment project from the ground up. So you can see that just with this sample of deals that we're working on a lot of different property types in a lot of different places. One thing that I wanted to talk about today, because I think it's relevant to this group, is some high-level differences between a residential loan and a commercial loan. Our company and our team, we work solely on commercial loans. So what I mean by that is any property that's obviously a commercial property, an industrial property, office, mixed use, hotel, things like that, but also apartments, so long as they have at least 5 units. So single family residences, duplexes, triplexes, and fourplexes, those are residential loans, and the best thing to do if you're a borrower and you're looking for a loan like that is to go through, in my opinion, a residential mortgage broker. Our company, we just do the commercial loans. So when you start a commercial loan, or when one of your clients starts a commercial loan, the focus is mostly on the property itself. Commercial properties are very unique, and so lenders want to know, the square footage of the building, obviously, whether it's demised for multiple tenancy or single tenancy, when it was built, what the construction materials are, what the on-site parking is, what the parking ratio is, whether the building's been seismically retrofitted, things like that. And then obviously the location and traffic counts, and whether it's on a hard corner and things like that. Those are the primary focus for the lender, and also the credit worthiness of the occupant of the building that is paying rent if it's a leased building. And so if the tenant is Walgreens, a tenant that has investment grade credit, then that's a better tenant to have than Ben Johnson's Pharmacy. So the primary emphasis is on the property itself. The secondary emphasis is on the borrower, on their net worth and liquidity and experience. With a residential loan, I think that the focus is more on the borrower and their financials, because there is a lot of uniformity when it comes to single family residences, at least in most markets throughout the country. Second, closing costs. With residential loans, sometimes lenders will be able to absorb some of the closing costs. In commercial loans, that's almost never the case. There are some exceptions. JP Morgan Chase will cover some of the closing costs for their borrowers, but for the most part, borrowers have to pay the closing costs. They pay for the third-party reports. They pay for, if the lender hires counsel to prepare loan documents, those costs are borne by the borrower. Interest rates. My thinking as far as this goes on the residential side is that it's really a pretty narrow range of potential interest rates. Right now, you can probably still get a rate under 3%, even though the treasuries have come up. And if you were to get an interest rate of 6% or 7% on a residential property that you live in, then there's something that's off, right? It's a pretty narrow range of rates. With commercial loans for investment properties, there is a very broad range of rates. So on a really low leverage, down the middle deal right now on an investment property, let's say some apartments in a really good location, 30% LTV, you might be able to get an interest rate that's below 3%. Whereas if you go out and try to get, if you're buying a vacant multi-tenant property and you want to lease it up and you're looking for a hard money loan where the hard money lender can close in 2 weeks, you might end up paying 10 or 11% in interest. So there's a huge range of potential interest rates for commercial properties and the rate is determined by product type and really the specifics of the property itself. And so you see a lot of different types of loans and a lot of different numbers when it comes to interest rates for commercial properties. Fixed interest rate periods. With residential, it's common to have a fixed interest rate period that's longer than 10 years. On the commercial side, that's not as common. The most common fixed interest rate periods are a 5-year fixed, a 7-year fixed, and a 10-year fixed. And there just is only a select group of lenders that can go longer than 10 years fixed on the interest rate. Life insurance companies are one of them. A life insurance company can do a 15-year fixed on a commercial deal. They can do a 20. They can do a 25-year fixed. Some of the life insurance companies can do a 30-year fixed on a commercial property, which I think almost every bank that I know of just can't do that. In terms of what I would call heavy lift document requests for loan approval, pretty uncommon in residential. It's a pretty streamlined process. I just completed a refinance with the residential mortgage broker that I use. And it was, the whole loan process was online. I could upload documents there. I didn't really have to prepare any documents from scratch. And so it's pretty uncommon to get a heavy lift document request on a residential loan. On commercial loans, it's pretty common for the borrower to have to prepare a document that takes some time to prepare. I'll give you an example. If we were doing a loan on a 6-unit apartment property, almost every lender out there would ask for a 2021 year-to-date profit and loss statement for the property. Well, a lot of our clients, 3 months into the year, 2.5 months into the year, don't have a P&L ready for 2021 year-to-date, and so they'd have to prepare that, and that takes some time. Do you need a big team of people to close a single-family residential loan? Probably not. That can just be done by the property owner. On commercial loans, depending on the deal size, if it's a $15 million loan, you probably need a team. You need a team of people, probably a lawyer, hopefully an accountant, and hopefully a mortgage broker as well to help. Personal credit decisions on residential loans, those are monitored. Residential lenders don't want you, opening up a $40,000 line of credit in the middle of a loan process. On the commercial side, that is personal credit decisions during the loan process are not, lenders don't pay that much attention to those. And then finally, the closing time frame. I think that this is something that comes up a lot when we're working with a buyer who's doing their first commercial loan and their agent has limited experience working on commercial loans. In general, it just takes longer to get commercial loans closed than with residential loans, and that has to do with the complexity and unique nature of commercial properties. There's not a lot of uniformity in the commercial world. Every commercial property is really unique, and so on just conventional loans, on investment properties, they typically take 35 to 60 days to close. But if it's an SBA loan and the borrower is not very responsive, sometimes that process can take even longer than 60 days. I'm going to stop for a second before going on to the last couple of slides here, which deal with SBA loans. And I just want to talk about non-SBA loans for a moment. So our team of 4, we work on a split of, a mix of investment property loans and owner user loans. And what I mean by investment property loans are loans where our client owns the property but doesn't occupy any of the space at that property. They're just using it as a straight investment. And so I was contemplating putting a slide in here to show the group, what interest rates look like right now for investment properties, but it's a very broad range. It's a very broad range. What I would say is that very well located properties where the request is a low loan to value and the product type is one that lenders like, let's say multi-tenant industrial or apartments or something like that. You can still get interest rates that are just a little bit below 3%. But in general, most interest rates for investment properties right now are in the mid 3s to high 3s, with some getting into the 4s as you get into property types that lenders don't like. So you ought to favor investment property types that lenders are concerned about right now and consequently assign higher interest rates to are unanchored strip retail properties, suburban and urban office, hospitality properties, both flagged and unflagged, and mixed use properties that have a retail component to them. Those are the product types that have been hit the hardest by the pandemic. And so lenders tend to quote higher rates for those property types. The in favor property types right now are multi-tenant industrial, apartments, grocery anchored retail centers, and then single tenant net lease properties where the tenant has very good credit. Walgreens, Dollar General, 7-Eleven, Advanced Auto, O'Reilly Auto Parts, etc. The other type of loan we work on, so you've got the investment property loans, but we work on a lot of owner user loans as well. And I divide the owner-user loans into two categories. One, you've got conventional owner-user loans, where usually the property owner can borrow up to 65, 70, 75% loan to value on a building they own or on a building that they're buying. And that loan process is very similar to a conventional loan for an investment property. And right now, interest rates for that type of loan are in the high threes, depending on where the property is and the strength of their business. What I mean by owner user is, a property where the owner of the property has their business in the majority of the space. So either they own the entire or they occupy the entire building, or they occupy at least 51% of the space. By far, the most common request we get for owner-user properties is for SBA loans. And so I wanted to talk about those in a little bit more detail for the last few slides here, because I think a lot of your clients are business owners and might be looking to buy a building that they'll occupy or move their business from one property to another. Perhaps their business has grown and they're wanting to move into a bigger building, and they need a loan to buy that building. In general, the SBA is kind of a hot lending option right now because their rates remain very competitive. So there are two main loan programs at the SBA they're on this slide. I've put one in each column. The first one is the SBA 504 loan. It's typically used to purchase real estate only. So if the buyer were purchasing land, building, and a business that's in that building already, that's not a good candidate for the 504 loan. There can't be a business component. It's usually just used to purchase real estate only. So the borrower needs to owner occupy at least 50% of the building, and the borrower can get really high leverage on something like this, up to 90% loan to value, which is significantly higher than the maximum loan to value on your non-SBA conventional owner-user loan, where you're usually capped at 65% or 70%, or for some banks, 75%. So really high leverage is available. Even though the SBA 504 loan is geared toward people doing perhaps their first commercial loan, or maybe their second commercial loan, or basically people that don't have a lot of experience doing commercial loans, it is kind of an exotic loan product. Although SBA lenders go to great lengths to make it not an exotic process, hopefully. But the loan has two parts. There's a first mortgage that is run by a traditional lender in the first, and the loan goes in the first position. And virtually every big bank lender in the country does this type of loan, does an SBA 504 loan. And the second part is a second mortgage, and that whole process is run by an entity called a CDC. CDC stands for Community Development Corporation. These are companies that are authorized by the SBA to originate these types of loans, and it's the CDC that interacts with the SBA during the loan process. The SBA does not interact with me as a mortgage broker. The SBA does not interact with the borrower. They're not set up to interact with the public. So the CDC is your line of communication between the SBA and the originating bank and the mortgage broker and the borrower. So the lender doing the first mortgage is running their process, and then the CDC is running a parallel process at the same time. And what you end up with is a blended interest rate. To give you an idea, we're working on a 504 loan right now on an office condominium in San Francisco. and the bank's portion is going to end up being at 4.15% on a 7-year fixed, and the SBA's portion, or the CDC's portion, the second mortgage, is going to be at an interest rate that is set by the SBA, and the SBA's posted rates usually change every month, but I believe that in February they had rates that were below 3%. So on this loan, when you take the 4.15% and blend it with the second mortgage, this borrower is going to end up with an interest rate that's in the low threes, and we're paying off a loan that was at 6%. So he's very happy about the rate. So you end up with a blended interest rate. The other SBA loan product that is actually far more common than the 504 is an SBA 7A loan. It's a lot more flexible. It can be used when the borrower is buying land, building, and a business. It can also be used when the borrower does not own the building that they're in. We closed an SBA 7A loan a couple of years ago for a borrower who was a tenant in a building, and he had extensive equipment for his business. And to buy that equipment, he had borrowed money at between 9 and 10% with an equipment lender. So we paid that off. The loan was about $850,000, and he ended up with an interest rate significantly below what he had with the equipment lender. So it's just the SBA 7A product is a lot more flexible than the 504. What you end up with is one loan that can go up to 85% loan to value, one interest rate. And the way these things price is over the prime rate. So it's usually a spread over prime that can be anywhere from 100 basis points to 250 basis points over prime. Prime is 3.25 right now. So interest rates on an SBA 7A loan are 4.25 to into the fives. And you've got a traditional lender running the process and a CDC involved as well. Some other features of SBA loans, both positive and negative, I guess. They do have kind of a complex structure. I mentioned earlier that on the 504, you've got two different loans. Before the pandemic, one of the big digs on the SBA loans is that they come with high closing costs. That's no longer quite as true for reasons I'll get into in a second. But the borrower does have to pay for the appraisal and other costs incurred by the lender during the loan process. This is still true, but bullet point number 3. There are a lot of documents requested for a typical SBA loan, and that's one of the reasons that I'm along for the loan process is to help with what I can and explain why certain documents are needed. But because there's a government entity involved and the SBA has to approve the loan, they review, they request a lot of documents and they review those documents. One of the positives is that your client can get really high leverage on the loan, and we know that in the Bay Area, it's hard to find an owner user property for, let's say, $400,000 or $500,000. So a lot of these purchases are over $1 million or even $2 million or $3 million, and there just aren't that many business owners that have the wherewithal to put 30 or 35 or 40% down on a purchase if you're buying a $2 or $3 million building. So that's one thing that's nice about the SBA is the leverage. The SBA started a promotion in 2021. It applies to loans that are signed up anywhere or that close anytime between now and the end of September. And it varies from loan to loan, but in general, what they're doing is they're paying the SBA guarantee fee. Actually, they're waiving the SBA guarantee fee, which is usually the biggest closing cost in an SBA loan. To give you an idea, the guarantee fee is on a sliding scale, but it's anywhere from 2% of the loan amount to 2.65% of the loan amount. So you know, 2.65% of the loan amount on $1 million loan is a huge chunk of change. That's, you know, $26,000 or $27,000 in closing costs that right now for loans originating by, you know, closing by the end of September, the SBA is gonna waive that. They're also making the first few months of mortgage payments for the borrower. The promotions that I've seen on live deals right now are anywhere from 3 to 6 months. The first 3 to 6 months are paid by the SBA, which is a big deal. On a recent loan we worked on for a restaurant building that a restaurant was buying, the first 6 months of mortgage payments added up to $39,000. So the buyers were getting, you know, we're not going to have to come up with that 39 grand to make the first 6 mortgage payments. Finally, one thing that's good about the SBA is they're always lending. Last year, mid-March, April and May, a lot of traditional lenders that borrowers would just go to directly either stopped lending or hit the brakes on their lending program, or only kept lending on certain product types, like let's say apartments and industrial, and decided not to lend on retail. The SBA doesn't do that. They tend to be active, rain or shine. The biggest year in terms of number of dollars loaned for the SBA was 2011, which was a year when a lot of traditional lenders were not putting a lot of money out. 2012 was another huge year for the SBA. 2015, which was a boom year, that's not surprising, and then 2020 was one of their best years. So they had a bigger year in terms of lending money to property or to business owners last year than they did in 2019, which was a boom year as well. So there's one other thing to mention here, and that is that the traditional lender, or that is running the loan process during these SBA loans, they really like doing these deals. And the reason is that the SBA makes a guarantee to the bank who's running the loan. And this is the guarantee. If the bank suffers losses as a result of the loan, the SBA will take care of 85% of those losses. So for banks, it's a you know, they get to interact with a potential depositor and client and originate a loan for them with limited risk to the bank. So that's all the material I had to cover today. I'm happy to answer any questions that you have about loans on investment properties, conventional owner user loans, or SBA loans.
All right, great, thank you. Let me pull out. Let me get this to pop up. So one of the questions is, do these loans apply to nonprofits as well? I need to get this to pop up so I can see them better. Here we go. Let's go through them. If a corporation, a community nonprofit, is looking to buy residential property for their operations, is this going to have a commercial loan or possibly residential? I'll let you answer that.
Yeah, that's a good question. I mean, whether or not it's a residential loan or a commercial loan is just determined by the number of housing units at the property. You know, if there are at least 5 units, then it's a commercial loan, and if there are fewer than 5, then it's residential. But I don't believe that nonprofits can do an SBA loan. I'll confirm that with my sources after the call. And if you want to email me directly so I have a channel for responding to you and confirming this after the call, I can do that. But there are owner user lenders, at least 2 or 3 banks that I can think of that will make a loan to a nonprofit. We've worked on loans where the buyer is a religious organization buying a church or a sanctuary or religious facility, where they will hold services And so there is a market for that type of thing now, for that type of loan. But the ones that we've worked on have all been non-SBA. They've all been conventional. And the underwriting and approval process for a nonprofit is much the same as for conventional lenders. Conventional borrowers. The lender is going to want to see the financials of the nonprofit. And I believe that nonprofits are required to file Form 990 with the IRS anyway. So it's, in general, the financials of nonprofits are public record. But for religious organizations, if the nonprofit has a religious tie-in, lenders usually want to know about donations and attendance at worship services and things like that. So there's an entire market for borrowers who are nonprofits, but I don't think you can go the SBA route for that type of thing.
Does the 85% guarantee reduce the bank's loan loss reserve requirements?
I believe it does. Wow, that's a good question. I believe that it does, and I'll give you an example. It certainly changes their accounting in terms of their balance sheet. So I'm working on a loan request to refinance a flagged hotel in the Bay Area, and the request is for $10 million. And one lender that is providing a quote is doing the quote through they're putting together an SBA loan option, and I think the borrowers would prefer to do a conventional loan, and so I wanted to see if this lender could put together a conventional quote, and they didn't have interest in doing that. They have plenty of hotel loans on their books right now, and if they put this one on their books as a conventional loan and non-SBA, they'd have to put the whole $10 million loan on their balance sheet on their books, and 100% of the loan dollars would show as a hospitality loan. If this bank does the loan as an SBA loan, then on their books they don't have to show the entire, for concentration issues, they don't have to show the 10 million. It's reported differently on their books, and they can do more hotel loans by going the SBA route with this loan than if they did it the conventional route. So it certainly does impact the accounting for each lender.
Cool. Any other questions out there? This is your going once, going twice, strike three. So let's say you are formulating questions. Here we go. Does the SBA 504 or 78 programs help the lender comply with Community Redevelopment Act?
I don't know the answer to that question. What I can tell you is that most local, community, and regional banks have a special bucket of money for Community Reinvestment Act loans, but that money is usually administered through the conventional route. So I'm working on a loan request for some master leased SROs in the city of San Francisco, and the tenant is a nonprofit that provides transitional housing to the homeless. And a number of the lenders that are providing quotes, are doing so on a conventional basis, on a non-SBA basis. But if they are successful in winning the loan, the money that will be loaned to the borrower will help that bank. What will come from that Community Reinvestment Act allocated bucket. So I know that there are a lot of banks out there that are consciously trying to earmark funds for that type of loan, but I don't know if money put out for SBA loans helps those lenders, check that box. But I will I'll find out, and please do email me after we're done so I can get you an answer.
Right. But then there's, let's see, does the SBA require the lender to sign an MOU or master guarantee with them?
I believe that the lender and the SBA have an overarching written agreement that is kind of an umbrella. It's not on a deal by deal basis.
Yeah.
Just, any SBA loan that you originate, Mr. Lender, will guarantee 85% of it. And I'm sure that there are other clauses and stipulations in that agreement, but every SBA lender does have a written agreement of that kind with the government.
And for those of you that were wondering, an MOU is a memorandum of understanding. There's a question about income required to get a commercial loan. I think the question is income required to get a commercial loan? I think I could even answer that, but why don't you?
Yeah. So with a conventional owner-user loan, income is definitely required, and certainly for conventional investment property loans, income is required. It doesn't have to be a certain type of income. That is, W-2 income doesn't. W-2 income counts the same as net rental income from investment properties. So a lot of our clients have zero W-2 income. They have no W-2 income at all, and they have no problem getting a commercial loan through the conventional route. What is unique about the SBA loans is that through the 7A loan program, you don't necessarily have to prove that you, as the borrower, have been making enough money the last few years to pay the loan once it closes. What I mean by that is an SBA 7A loan can be based on projections for the business. That is, what the business owner expects to do in cash flow over the first few years of the loan. And that's pretty unique. If you try to get a conventional owner-user loan, it is almost never based on projections. It's based on what your business has been doing the last few years. So through the 7A program, you as the borrower can provide a business plan and cash flow projections to the lender, and the loan can be made based on the projections. So that's one aspect of the 7A program that is really attractive.
And then there's a question about what criteria is used to determine down payment on an SBA 504 loan.
Well, what the main ratio that lenders look at is a global debt service coverage ratio analysis, and in that analysis they basically take what they expect the borrower to have in gross income during year one, and they subtract all of their expenses. So expenses for the business, expenses for utilities at the borrower's primary residence, credit card payments, house payments, car payments, everything like that, and mortgage payments. And so the gross income divided by all the expenses needs to be at a certain ratio. And usually what they're trying to hit is 1.25 or higher. So if you take all the borrower's incoming money and divide that number in a year by all of their expenses, that ratio needs to be at least 1.25. What that shows the lender is that when all the bills are paid, there's something left over. for the borrower. What they don't want to see is a ratio that's really thin or that's below 1, where you know the borrower right out of the gate, year 1, is not making enough money at their business to pay all their bills.
All right. Let's see. So there's a question. Have you gone over the best approach for us to communicate with the potential borrower to approach them about a loan, and how would we work with you on sending referrals? So I think what I would say to everybody out there is that you have a client that is interested in buying commercial property and they need to get a loan, that you reach out to Ben and introduce your client to Ben and let him talk to them about what they're looking for and what they qualify for. I don't know if that answers the question. And I mentioned this in one of the text messages, there's the copy of the handout is in the handout sections, which you can download, and it also has all of Ben's contact information.
Yeah, I mean, what my response there would be, you know, you can make an introduction between me and your client any way you see fit, whether that's calling my cell and patching in your client onto the call, or just introducing me by email. We see it a lot of different ways, but you know, most of the business we get are from real estate agents. It comes from real estate agents, and some of them, they just make an email introduction and then they just kind of disappear, you know, and we just work with the borrower directly after that. In fact, the very first loan I worked on with this team, an agent introduced his client to somebody else on our team on a $7 million loan, and that was it. We just kind of took it from there, and that's fine. In other cases, the agent wants to be along during the loan process, wants to know when the loan gets approved and when it closes and all that, and we're happy to do that as well. So, you know, feel free to reach out to me any way you like, either on my cell or with an email, and I will be as involved and have you as involved as you'd like.
And then let's have a final question: is does the borrower have to be in business for some length of time, or would startups be able to apply?
Well, there's no requirement that they be in business a certain amount of time. I think, just as a rule of thumb, if you're going for a 504 loan where you can't, the loan doesn't really qualify based on future projections of income, I think it'd be helpful for the business to have been around for at least 3 years, just to show how the business has been doing for a 3-year stretch. On the 7A side, though, because it can be based on projections, I'd say there's no minimum amount of time that a business have been around. The way that we would mitigate the life of the business being short is by showing that the borrowers have some expertise in their field, and or have certain, you know, have funding from their funding sources, or things like that. In other words, there are ways to mitigate the fact that the company might be really young. But if the company is young, I think that's like a tailor-made SBA 7A loan, because it can be based on projections.
Cool. Good to know there. That's what people are saying. It's good to know. So if you'd like to know more, particularly if you have a client who's actually, you know, that's serious and is thinking about investing in commercial real estate, needs a good commercial lender, reach out to Ben. You've got his contact information in the handout. If for some reason you can't download it, reach out to me, or just maybe Google search Ben Johnson Gantry mortgage in San Francisco, and I'll bet you find him, right? But
yes.
Out to me, I'll connect you as well. So that's great. I want to thank Ben. Everybody applaud. They're all, you can just see them. It's a standing ovation, I'm sure. See you guys later. Thanks all of you for participating today. I hope you found it valuable. I certainly did. And that's it. Be safe out there, guys. See you later.
All right. Hey, thanks very much.